Hi there, and welcome to the Final Bar. It is Thursday, May 30th, and I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the technical toolkit. The Stockcharts platform was created, 25 plus years ago as a way to empower individual investors to better understand the markets using the technical toolkit, analyzing price, trend, momentum, breadth, and sentiment. We try to hit on as many of those things as we can in our daily market recap show here at the Final Bar. Before we get into the charts and our great guest today, Jonathan Krinsky of BTIG, I do want to start with a poll question that we asked you recently on our social media accounts. We asked which AI play performs best between now and the end of August 2024. Gave you four choices: NVIDIA, Alphabet, Meta, super microcomputer. Full disclosure, I created this poll probably a month ago before I realized that utilities would be a key AI play right about now. So sorry for that one, but I picked the ones that I kind of knew. 72% of you going with the tried and true NVIDIA. Of course, I did not know NVIDIA at the time was going to have blowout earnings and sort of reassert their leadership role in this AI trade. It's so interesting. I've had a lot of conversations with people about the AI trade recently about NVIDIA and Alphabet and super microcomputers, MicroStrategy, others that have had these big rips to the upside. I'm always coming back to Fast Forward Investing, which is a brilliant book by one of our sometimes Stockcharts guest, John Markman, who talked about the idea of themes like artificial intelligence, like automation, like nanotechnology, driverless vehicles, et cetera, thinking about the promise of the theme versus the promise of companies and what they're doing. And I would tell you, to be honest with you, it always pays to just go back to the charts, right? In general, if you're wondering what's going to work, if you're wondering what's the place, what are the companies, the stocks that are going to work, the charts are often a really good way of telling you, because the charts very quickly tell you when something is no longer in a leadership role. When I'm looking at the daily chart of NVIDIA, the weekly chart of NVIDIA, I think the daily one's impressive. Look at the weekly chart of NVIDIA and just look at the consistent, beautiful uptrend that you have here. In a weekly chart with a log scale, when you can draw this kind of trend line, it's so pretty. I'm actually going to draw it here. If we can draw this kind of trend line and just set it and forget it, to quote Mr. Popeil, the Ronco guy, it's totally working, right? We have a consistent uptrend of higher highs and higher lows. This is on a weekly chart. And look at how we remain above this trend line support, which has been tested 1, 2, 3, 4, 5 plus times. So as long as we remain above that trend line, there's a lot of room for an NVIDIA to come down, which maybe we're seeing the beginning of that, as it's actually had a down day today. But overall, the longer-term trend remains positive. And that's what encourages me about this market as we question the sustainability of the uptrend, as we question whether the S&P will be able to hold above 5250, which it actually did not do today. Those longer-term charts still pretty constructive, and I think that's worth remembering. Let's get to the rest of our market recap, starting with the market overview, looking at the major equity averages. You see it's actually a little bit mixed, some red and some green. The Dow, the S&P, the Nasdaq, really the main benchmarks most would follow to track the U.S. markets, all in the red. The S&P 500 finished down 0.6% to 5235 and change. The Nasdaq composite was down over 1%. The Dow was down 0.9%. Mid-caps and small caps actually had a decent day, with the S&P 600 small cap index leading the way higher, around 1.2%. Look at the VIX, not quite to 15, but 15 is getting closer and closer, I would say, in front of us here. The VIX has gone from low teens, down in the 11, 12 range, back up to 14.5. And 15 is where I have an alert set. I would encourage you all in your Stockcharts login to have a similar alert set. If and when, and probably more when, we break above 15, again, doesn't mean the end of the world is occurring, but it certainly means that the conditions that have been in play since the April low are no longer working. Right? I mean, something's different, what we call a change of character. So keep an eye on that, and for now, the VIX kind of going the wrong direction if you're all bulled up and expecting further upside. A couple of comments. Actually, we'll continue with the major averages, and I have a couple comments on the S&P versus the Nasdaq versus the Dow. But let's get through the rest of these sort of big markers talking about market conditions. Looking outside of the equity space, you can see interest rates overall moving lower, bond prices moving higher. The TLT, which is a treasury bond ETF that we like to track, was up about 1% today. Yields, of course, are coming down. If that's the case, there's that inverse relationship between price and yield when you're talking about fixed income markets or the bond markets. And so the 10-year yield coming down to finish today around 455. The long end of the curve, the 30-year point, still just below 4.7%. Short end of the curve, of course, still above both of those. And that first Fed rate cut is getting pushed further and further down the road. We have the next Fed meeting here in less than 2 weeks. Just slightly above a 0% chance that the market is pricing in that there's any change to interest rate policy at this June meeting. Most likely it's pushed down into the fall, and we'll see if that continues to be pushed further and further. But rates higher for longer, generally speaking, today's pullback aside, certainly seems to be the rule of the day. The commodity markets overall moving lower, although gold did manage to finish slightly higher. The GLD ended the day around 0.2%. It was up a lot more earlier in the day. It actually rotated down and finished more toward the lows of the day. Silver and copper prices both down over 2.5%. Oil, natural gas prices all down as well. So generally speaking, commodities did not have a particularly strong day. Bitcoin currently up over 1%, but it's rotated lower during the equity trading session, particularly in the afternoon equities. Bitcoin currently around 68,300. Ether prices around 37.33, and that's down about 0.8%. Mixed results for the rest of the major sort of top 10 cryptocurrencies that we track on our platform. Looking at the sector summary, you can see by the end of the day, it was a lot about the defensive areas of the market. REITs, real estate, number one, up 1.5%. Utilities, another fairly defensive sector, up 1.4%. Materials, number three, up 0.8%. On the downside, only 2 of the 11 S&P sectors down. Unfortunately for the major benchmarks, there's some of the biggest weight. So technology, the XLK was down 2.3%. That is dominated in a lot of ways by Salesforce, which was down about 20%. I didn't see at the close. We'll look at that chart here in a few moments. But Salesforce really getting dinged after earnings yesterday, after the close, sold off in the after hours, opened a lot lower, continued lower for most of the day. But also NVIDIA and some of the other leading technology names also got pushed down through the course of the day today. Communication services, the XLC was down about 1/3%. Healthcare, third from the bottom, basically unchanged from yesterday's close. Looking at the Magnificent Seven and Friends, these 8 leading growth names, mega cap growth stocks. Tesla, actually at the top of the list, up 1.5%. So Tesla has been one of the worst performers in this bucket of stocks, but actually popping higher today. Apple, which still remains largely range-bound, up another 0.5%. The rest of these names were all going lower. And look at the market cap represented on some of these stocks that were down over 2%, over 3%. NVIDIA down almost 4% today, closed around 3.8% lower. It was down lower even more earlier in the day before rallying into the close. Microsoft down over 3% as well. Alphabet down over 2%. So those largest names within the technology communication services stocks all getting dinged pretty good here. Let's look at a daily chart of the S&P 500. I'm going to talk briefly about the S&P versus the Nasdaq versus the Dow. And if you've always sort of wondered about those 3 benchmarks, why we have 3 different ones and what they mean, hopefully this will help make sense of things. So the S&P, the most widely followed benchmark in the U.S. for good reason. It is a broad representation of about 500 companies. The problem with the S&P 500, it is very top heavy. So the top 10 stocks, the Meta, Microsoft, Alphabet kind of names, make up, about 1/3 of the index, I think, about 33%. The bottom 425 stocks are about 1/3 of the index by market cap weight as well. So the top 10 and the bottom 425 have an equal impact on the S&P. That's why the S&P moves in very close relationship, high correlation to the movements of those Magnificent Seven stocks, because they're just the biggest part of that calculation. So the S&P itself, pulling back obviously in the last week, it's worth noting that the all-time high for the S&P was on this big bearish engulfing pattern day about a week ago. That was last, I think, Wednesday into Thursday, if that's right, or Thursday, Friday. What's interesting about that, to be honest with you, is when the all-time high, which we just happened, we just experienced, was a bearish engulfing pattern, a bearish candle pattern. It doesn't make me feel great about the current conditions of the market. Certainly speaks to short-term weakness as opposed to short-term strength. And as you can see in the weeks since that, or the 4 trading days since that pattern, overall it's been a lot of weakness rather than strength. But we're still above pretty key trendline support. Today's close did get us briefly below 52.50. We've now closed below that green shaded area on my chart. We're getting really close to what I would consider a confluence of support. That's where you have multiple different indicators all agreeing at a similar kind of level as being kind of meaningful. The 50-day moving average currently around 51.80. a trend line using the major lows for the last 6 months is almost at the exact same level. So you kind of have this range where it's pretty reasonable to expect some support. If we would test that range, you'd expect at the very least a little bit of a bounce. I think the question is going to be what happens after that point. Do you see further deterioration? Do we even pause there? And if not, that's when things could get more and more uncomfortable. Now, the Nasdaq 100, this is the QQQ that we're looking at. What's the difference, right? The Nasdaq 100 of 100 leading growth names essentially is what I would think about it. It's the names like Microsoft and NVIDIA and others. To be honest with you, the components of the Nasdaq 100 look very similar, particularly the largest names look very similar to the largest names in the S&P 500. That's why there's been a very high correlation between these two indexes because they're really dominated by the same names. The Nasdaq 100 dominated even more by those leading growth names. So the Qs have gone down about 10 points, right, from peaking around 460 about a week ago to where we're at just above 450. So that's 10 points, 2.5% off of the all-time high. So we're still, early on in any sort of pullback phase. If we would continue lower going into June, look at the downside you have, the space you have to get down to the most recent major low, which would be around 415, which was from mid-April. So 6 weeks ago, we're down around 415, so about 35, 40 points below current levels. That's the room that you have to put in a higher low and still be within a primary uptrend coming off of the low from October of last year. That's the reality of this market that has been remarkably strong and obviously driven by some of those leading names that have done a lion's share of the gains. So what happens on a day like today when the technology communication services stocks are getting dinged? The Nasdaq is down 1.1%, but the Dow, which I would tend to think of as a more value-oriented, more conservative group of stocks, how come the big industrial index is still down 0.9%, or those other names down as well? Here's the kicker, and this is where I love our Stockcharts dashboard because you can look at something like market movers, look at the Dow Jones, and look at the stocks that are down the most. What you'll notice is that things like Salesforce.com, Microsoft, Amazon, IBM, these are all components in the Dow Jones Industrial Average. When Charles Dow originally created the group of 15 stocks, now it's 30 names, it were really industrial companies. Think like GE, GM, 3M, kind of like big conglomerate industrial kind of stocks. That was the general idea. Things that make, companies that make things and big things and then sell them and distribute them with through other approaches. Salesforce, Microsoft, Amazon, IBM, these are all part of more of the service economy. These are companies making their money on services, not on products, based on cloud and AI and all these other things that really didn't exist when Charles Dow really envisioned these indexes. So the Dow being down 0.9% is really being hit by the same thing that the S&P and the Nasdaq, which are some of these big leading names, are getting dinged so much. And when Salesforce is down 20%, it's one of only 30 stocks in the index, so it's going to get driven a little bit lower. You'll notice there are stocks like Honeywell and Verizon and Amgen and Travelers Insurance and Visa, which are not in that growth space necessarily and are actually doing okay today. It's just that's not enough to counteract the negative move in some of those names that have become a big weight in the Dow Jones Industrial Average. So there's your quick primer on those three indexes, how they related, and really the index components are what you want to focus on in terms of what's actually driving things. I can't help but notice looking at today like today, the defensive sectors at the top of the list. We talked about utilities and real estate and the danger of those sectors being particularly strong. Again, it's not end of the world yet. And on my Mindful Investor Live chart list, one of the charts that I love to focus on is this one right here, which looks at the three kind of pure defensive sectors: utilities, consumer staples, real estate. When these sectors are outperforming, it usually means market conditions are not particularly strong because generally speaking, investors would go into utilities and consumer staples and real estate when they're trying to not own things like growth leadership or value leadership like energy or industrials or materials. They're trying to hide out in a low volatility, low beta type of play. Now, utilities are a bit of an outlier right now because they've become, honestly, a big AI play. I feel like everything is in an AI play in some way, right? And most earnings calls, even if they have nothing to do with technology, will talk about how much AI is a core part of their business. Caterpillar on one of their calls was talking about how significant it was in terms of driverless tractors and other things. And so everyone, of course, is caught up in the value of AI and its ability to transform businesses. But from a relative on a relative basis, I think looking at something like consumer staples or real estate starting to do consistently better would be a big warning sign. It's not really happening in a major way yet. Consumer staples still, generally speaking, are in a relative downtrend. They're really more sideways over the last couple months, to be fair. Real estate, even though it popped today a little bit, still underperforming over the last couple months. So watching this chart to see if and when you see a defensive rotation away from some of these other sectors that have dominated for so long, I think that could be a real warning sign, not of a brief pullback, of a tactical pullback, but more of a more significant, concerning sort of pullback. Check in very briefly here on the VIX because we're not quite to the danger level of 15, but 15 is getting closer and closer. By the way, the VIX just closed above its 50-day moving average here for the first time since early May. That did happen as we've bumped up. A couple days ago here, we're down in 12, just slightly below 12. We were at an 11 handle at one point. With today and yesterday, we've now popped higher to just around 1450. VIX above 15, again, is not the end of the world. Last two times we've broken above 15 were in early April. Here in mid-September, those were sort of during a pretty established corrective phase and during the April pullback, which, I mean, granted, after the pop above VIX 15, we rolled over for another couple weeks and had a pretty, the most significant drawdown so far in 2024. But, so looking for that break above 15 can be a great warning sign that things had been in a certain realm, or we're in a certain phase, a bullish low volatility phase. VIX above 15 tells you at the very least that something's different, right? We're no longer in a low volatility uptrend, and I think you need to reassess. So again, I would encourage you to set an alert and check if and when the VIX gets above 15. We'll finish off our market recap looking at a couple individual names. Salesforce.com gapping lower. Earnings were not great. What's interesting about the chart of CRM, I would argue, is that the trend has been down now for a couple months, right? If you look, CRM peaked in early March, just below 320. From there, we stalled out and bumped up around 310 as resistance for about 4 weeks before gapping lower, and I think that was a telling gap in April. Then look what happened. We sort of gapped lower, we consolidated for about a month, traded back up to fill that gap at a descending 50-day moving average, and up until today's gap lower, we were sort of sitting around support at 270. I think this gap lower is a concern, and what's interesting when you have a gap lower like that is to see where we close, right? We opened down here around 225. Did you see buyers come in thrilled to buy Salesforce at a deep discount? No, it actually sold off. It did bounce a little bit going into the close, but still down around 20% from Wednesday's close. So overall, I would argue this is a chart now in a distribution phase. I'm immediately looking down to those October lows, which would be around just below 200, 195, we'll call it. Maybe that's where we have the next level of support. But for now, this is a chart very much in a downward phase. As our last stock, why don't we finish up on a strong note? It's so interesting if you invest in individual equities, and I've learned this in 24 or so years doing this, is that there's always some stock somewhere breaking out, and that is one of the realities of equity investing. While there will be a macro theme, while the broader market and a lot of stocks will tend to follow the general trend in the market, I was told a rising tide lifts all boats, and that's why you look at the chart of the S&P and think about the big picture environment. But you have to remember that even when things are all looking weak, stocks like a Bed Bath & Beyond, or in this case, Bath & Body Works, are actually gapping higher, trading higher. BBWI closed up over 4%, closing above $50 a share. It's actually really threatening to break out of resistance. You may want to call this a little cup and handle pattern. I probably wouldn't, because cup and handle patterns are really meant to be much more of a broader pattern that takes months and months to form. So I would think of this as more of a pull back and a brief test here around 48 before rotating higher. So what I love about a chart like this, it includes what I would call a natural stop. And what that means is when you look to the left, you see a recent swing low, and as long as you lock in any losses above there, meaning a stop around 48, you're basically betting on any further upside above current levels. You're limiting your downside to 48. Why not take a shot at something like that, a stock that is showing signs of constructive behavior at a time when a lot of the leading names which have done so well for so long are starting to show a little more weakness than you might expect. Folks, that's it for our market recap. We're going to bring on today's guest, Jonathan Krinsky, here in a few moments. Before we do so, just one quick reminder. We'd love to hear from you, particularly the questions that come up as you are trying to analyze the markets and trade using technical analysis. Our email is thefinalbar@stockcharts.com. We're on the Twitters @finalbarsctv. And here on YouTube, just drop a comment below the video that you're watching. We would so like to hear from you, and we would appreciate your questions very much. I want to welcome on today's guest, Jonathan Krinsky. Jonathan's the Chief Market Technician at BTIG, coming to us from Minneapolis. Jonathan, it's been too long. Welcome back to the show.
Good to be back, Dave.
No, so the market obviously getting dinged a little bit today. We're seeing a bit of a rotation lower. NVIDIA, which I don't think has had a down day in forever, actually pulling back a little bit. As you take a step back and try to put a day like today into context, what stands out to you, macro picture?
Yeah, I mean, it continues to be kind of an either-or market, and what I mean by that is, oftentimes we have a day like I think it was yesterday where we had pretty weak breadth, but some of the the Mag 6 or whatever you want to call it these days kind of masked some of the weakness, and then you have a day like today where the Mag 6 are actually underperforming and you actually have good breadth, but the index level is actually down a bit because of the weighting of those names. So, I think when we look across the landscape, yes, the index is at, not far off highs and the trend is still very good. And that's not going to change unless you get those big names starting to falter. You need to see more than just a day like today. You need to see several days, if not weeks. But clearly there's been a deterioration in breadth under the surface. And we can get into some of that at a later point.
You have a series of ratio charts you brought with us. I'm really excited to sort of talk through these and what they mean, because I think it's great sort of comparative analysis, thinking about what stacks up to what in the markets. We're starting off with a look at breadth, really, and the breadth conditions I'm sort of thinking is deteriorating. What does this first chart sort of tell you about the conditions, certainly going forward as we enter into June?
Yeah, so this is just the percentage of stocks in the S&P 500 above their 50-day moving average. And you can really see it kind of peaked out at the end of last year into early 24. We had a lot of talk, after that breadth thrust off the October lows last year. We had a lot of talk about expansion and breadth broadening out, small caps joining the party. And we were open to that thesis, but that kind of stalled out. And now you can see since then, we've had a series of, 3 lower highs, a couple lower lows in that metric. And so, whether you're talking about stocks above the 50-day, 200-day, any different number of breadth metrics, clearly there's been some deterioration. I don't know if it's enough yet to, to sound the alarm that we're going to have, anything meaningful for a drawdown. But I think it's enough to, we've been calling it a yellow light, enough to put bulls on notice that maybe we need to see a little consolidation, if not something more severe.
It's really, really interesting. And again, just looking at the contrast from the end of last year to where we're at now, half the S&P now apparently below their 50-day was above before there. Your second chart, a really interesting look at an equal-weighted consumer discretionary versus the equal-weighted S&P. What is this telling you here?
Yeah, so we like looking at this because obviously it takes out the impact of your big mega cap names in the consumer space, such as Amazon, Tesla, Home Depot. And so what we can see here also, this kind of peaked out last summer, tried to stage a rally when breadth broadened out towards the end of last year, kind of churned around, and then around April really took a leg lower. It is seeing a bounce over the last couple of days, but I think when you look across the consumer sector, there's just too many points touching the consumer to call it, just kind of a one-off. And whether you're talking about boats and RVs, auto part retailers, restaurants, and now to be fair, there are a bunch of idiosyncratic single stock stories. We highlighted yesterday that Abercrombie and Fitch actually is beating NVIDIA since the end of 2022. A staggering move. And so you've had a lot of idiosyncratic names within the consumer space that are doing quite well. But when you take a step back and look broadly, there's just a lot of weakness. You can go on to the transports, the truckers, those obviously have touch points to the consumer. We can go down the line. And so that's really starting to be a concern. And I think, what everyone was looking for in 2023, I think with higher rates impacting the consumer, maybe now it's, there's that lag effect, and we're starting to see it show up, across many parts here.
It's a really interesting chart. And it makes me think on a day like today, obviously we're having more of a down day, but we've had utilities toward the top of the leaderboard a lot of times. Part of that could be sort of an AI kind of play, but pretty defensive sector. REIT's the #1 sector today. Has that resurgence in some of the defensive areas of the market give you pause at all about the conditions here?
Yeah, I mean, typically, it's funny. We actually liked utilities in April coming in. Nothing did not think there would be an AI play. It was more just they were a little defensive, maybe down and out, starting to turn the corner. So we thought there'd be an opportunity there. Did not think the AI story was part of that thesis. But I think when you really have to be concerned about defensive leadership, it's when everything's going down and defenses are going down less. When you have a move like utilities or even staples moving up, that's not necessarily the most bearish sign. It could just be an interest rate play or a rotation play. But really, yeah, watch out if we start seeing all sectors go down, but those defensives going down less. That's classic bear market behavior.
Your last chart is an interesting ratio, one that I've not looked at very often, so I'd love for you to describe it. This is the IGV, which is an iShares Expanded Tech Software ETF versus the Qs. Obviously going lower in a big way. What is this telling you?
Yeah, so to be fair, the IGV is heavily market cap weighted, and Salesforce has a big weight in that, and so
Sure.
you're really seeing a significant chart move lower on the heels of their earnings today. But clearly, the trend has been moving lower for the last several months. Today, actually, last we checked, if we look at the performance of the IGV to the Qs, it was down nearly 5%. So it was, software was underperforming the Nasdaq 100 by nearly 5%. That would be the worst single day on record for this ratio back as far as we have data, which is to 2002. So just a pretty staggering move. If we look at software on an absolute basis, it's kind of into its 200-day moving average for the first time since March of 2023. So it's going to be interesting. Maybe you get a little bounce, oversold bounce, but clearly that relative strength isn't great. And I think it just speaks to the fact that that money within tech even has still been rotating to the AI trade. And that's really, to us, the key ingredient to the whole market, because semis now are actually the biggest industry group in the S&P. They just overtook software. So
Wow.
really it comes, if we're losing the consumer parts of the market, a lot of other parts of the market are kind of back and forth, but if we start to lose semis, that's really the key fulcrum for the S&P in our view.
When you're looking at the chart of the S&P 500, I'll bring up the daily chart here. Obviously, since the gap higher about 2 weeks ago, we've been sideways today and yesterday, now starting to roll over a little bit. I mean, still in an uptrend, I would argue, by any stretch of the definition from a technical perspective, but you're starting to see some short-term weakness. What do you see on this chart that tells you, okay, we really need to start getting defensive? Is there a particular signal? Is it more looking at the sector and group themes that would inform that? What would tell you that we need to start getting out of the way of a more bearish phase here?
Yeah, I mean, I think we just had one little signal, which is that we broke out above the April highs, which I think was 52.60, and now we're back below them, right? So that's not fatal, but it is at this point a little bit of a false breakout. So I think the longer we spend below 52.60, the more defensive you'd want to become. Some people have mentioned support's not it's not a definite line. It's more of kind of a mattress. So you could still argue we're still within the confines of the April highs, but I think again, the more time you spend and the deeper you go below 52.60, that's a concern. Obviously, you have that uptrend line drawn there off the fall lows. That would be another signal if you broke that. And then it goes back to watching the breadth. If we continue to see weak breadth broadly, and then you see those leadership names like the semis falter, that's going to be ultimately what brings a bigger drawdown for the S&P. So I don't know that we're there yet, but again, we talk about this yellow light. I think it's a time to slow down and just maybe have some more defensive posture at this point.
It's interesting when you look at the chart of the S&P for the last 5 years, it's hard to miss the fact that we've had a major top pretty much every summer going back over time. We're sort of getting toward that period. Sell in May and go away has, at times not been a particularly successful strategy, but do you see the signs forming for another summer top, and how would you navigate that if so?
Yeah, I mean, it's funny that sell in May, but it oftentimes is sell at the end of May, because I think June tends to be a bit more sloppy than May, seasonally speaking. And so, yeah, that I think, yeah, the fact that I think the reason we're probably, excuse me, struggling to hold that breakout above 52.60 is because we never got fully oversold during the April pullback. We actually thought we would get a bounce off the April lows, but then we thought before we made a new high, we would roll over for a deeper pullback, and that would have maybe gotten a bigger washout. So the fact we never really got that washout leads, maybe that's why we're struggling to get the thrust and hold above the upside. So yeah, I think summer could be choppy. Big picture though, I do think there's a lot of stats and metrics that suggest we probably haven't seen the final high, and it could be a decent year in the back half. But again, you just got to watch the consumer area, because if the consumer actually starts to buckle, that's something that we really haven't seen in a while, and that would be a concern. But yeah, right now, as you mentioned, the trend's still good, and we're probably assuming more of a choppy pullback than anything major at this point.
We only have about 30 seconds left, Jonathan, but I'd love you describing what are you telling your clients about opportunities in this sort of environment, given the questionable breadth, given the fact that we haven't had the follow through. Where do you sort of ride this sort of period out? Is it going defensive? Is it sticking with some of the big mega cap names that have been working? Like, where do you find opportunities given what you've said so far?
Yeah, I mean, a lot of them are, outside of the secular uptrend of mega tech, it's been more tactical in nature.
Yeah.
We actually thought energy was a tactical buy, and it still hasn't invalidated that. It's kind of right at a key support. So I think energy is worth taking a shot with, using some risk controls. And even China, which was a huge contrarian idea coming into this year. Yeah, FXI or the KWEB, it's probably the best it's looked in some time, and given the fact that the 200-day is starting to flatten out and turn up a little bit. So if that pullback holds here, we'd be looking at China. And then the last one is solar. TAN would be that ETF. Also, it's the best it's looked in some time, kind of clearing the 200-day. So there's some tactical opportunities, and that's where we'd be playing for now.
Yeah, First Solar, some of those other names really starting to work in that group. Jonathan, this was awesome. Can't thank you enough for spending some time with us, sharing some charts, some really interesting ratios to talk through, and some other ideas as well. So stay warm, enjoy the summer there in Minnesota. We'll talk to you again soon.
Thanks, Dave. Always a pleasure.
That's Jonathan Krinsky. Jonathan's the Chief Market Technician at BTIG, coming to us from Minneapolis. I love those first couple charts. Ratio analysis is such an important part, I would argue, of the technical toolkit. And if you've spent any time in the institutional community, ratios are so important because they help you understand how anything stacks up to anything else. At any given moment, you have different levers you can pull. So make sure you're focused on the things that are working relative to other assets. Ratios are a really good way to do that. On the Stockcharts platform, it's ticker number 1, the colon, the 2 dots, and then ticker number 2. You can look at a ratio of any tradable instrument. I would encourage you to experiment, make some chart lists, saving some of those key ratios. That's it for our show today, folks. Thanks so much for joining us every weekday after the close for the final bar. A special thank you to Jonathan Krinsky of BTIG joining us from Minnesota. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.